All right, folks, welcome back. This is going to be kind of like the direction we're going to be going in the future with the channel here. I'm wrapping up the mentorship teachings for this model, and we'll be just basically doing reviews and index futures, Forex, commodities when it's applicable. And I posted that on Twitter. That's kind of like a short little promo. And everybody was excited thinking that I'm going to be doing like 30 different markets every single day. It's not what I'm doing. So kind of give you a flavor for what it is that we will be doing. The mentorship group that I have with us, a private group, I no longer make videos for them. And one of the reasons why I started this project here is to steer people away from wanting to buy videos that aren't going to help you anyway. So when you're buying old videos, I'm talking about market moves for that particular day. So it's not going to be as useful to you. So to keep people from profiting off of pirated videos, I stopped making videos in my private group and I make them here publicly. Now, some of my students are upset that I did that. Others that understand why I'm doing it are in support of it. I'm not going to argue or wrestle with the opinions of who's in support of and who isn't in support of. I look at it this way. The folks that would have an issue with it, they're probably the ones that are trying to sell pirated videos. So now I've removed their market. So you're a fool if you're going out there and you're buying all these Instagram guys that are selling my videos. I got ICT mentorship 2021, 2022, 2020, 19, all the way back to 2016. You know, folks, they're not going to help you because you weren't there when it was given at the time it was given. That's being mentored. So that's what I'm kind of doing here, and I do on my Twitter account. So that way we understand why I'm doing it and what motivates me to do it. So there won't be a lot of markets obviously being covered each day. I'll be looking at the markets that I was referring to either on Twitter or I actually took trades in. So it's not a matter of talking about something that no one expected me to have an interest in, which is predominantly what you see here on YouTube and Instagram and Twitter and Facebook and Discord and you know, it's the list goes on and on. So today, 1 minute before 8:30, and I apologize. I was waiting for my phone to update its software, and by the time I got back on to Twitter, I had 1 minute left to type out everything that I posted, and you can go on my Twitter feed and you'll actually see the post in here too. But on the economic calendar, there was a high impact news driver for Canadian dollar. And I said I would start working in Forex. So there's a lot of you are specifically interested in Forex because that's predominantly what I'm known for. I've moved away from Forex recently because I wanted to be a part of the stock index futures market. And I'm still engaged, obviously, in that. I did some live trades today, and I'll share some of that with you as well. But I was covering the Canadian dollar. And what I was outlining is kind of like this idea, and we're going to use it also to work within the scope of the teaching on daily bias, and we'll get into that at a later time in this video. But right away, when you look on the left hand side, this chart here is the dollar CAD daily chart, and on the right hand side it's the hourly chart of the same pair, dollar CAD. Notice what we saw last week. The market traded up, just bumped the short-term high here with that daily high. What do we see once that occurred? What formed on that daily chart? You want to pause the video here. All right, if you need more time, pause the video because I'm about to continue. When the market ran into that old high here, it hit it, then the next day it created a lower high candle. So we have one candle, a higher candle high here on candle 2 and candle 3 or day 3. So this is what I dub a swing high. I'm not using a Williams fractal on MT4. I don't use MT4. This is not MT4 platform. And 5 candles, if you're waiting for 5 candles, you missed the boat. So this swing high at an old high. Did it run it? Not by much, but it did. That movement right here shown clearly on the hourly chart, and the following day creating a high that has a lower high than the highest one that ran into that old high. So we have a 3-bar pattern. One candle with a lower candle to the left, a lower candle to the right. That's a swing high. Pretty simple stuff. Then the next day, I'm going to be expecting the market to trade lower. Now here's the problem with this particular market. Yes, it's likely to trade down, and with the benefit of hindsight, I'm showing you here. But again, I tweeted about this beforehand. So at 8:29 a.m. Eastern Standard Time, you can see that is on my Twitter feed. If it's dropping down, we have this down close candle here. So it could be met with some resistance digging into this range of this down close candle. About half of its body right in here. And not surprisingly, you can see that's pretty much where we closed that candle here on the 21st of June 2022. So when we look at this dashed line here, what I'm anchoring to is the opening on this down close candle, because that is a bullish order block. Now, I'm not suggesting that we went into that to go higher. I'm just saying that as we started this down move, it's digging into this candle. So that's going to be the impediment to a big sudden one big candle that would take us down into this area here and clear out this. So over to the hourly chart, you can see last week we ran up into it, started drifting lower, fair value gap here, it rebalances to that, drops back down, consolidates between this high and the low here, comes back in, drops once more, attacking the sell stops here, consolidates once more, breaks, digs into that order block. Again, that's this level here. So watch what happens. It goes into it overnight, then it rallies. This rally here is ahead of the 8:30 news driver on the economic calendar. You can find it on forexfactory.com. But this movement here, this is all manipulation. That takes us up into an imbalance here, a fair value gap. Running a short-term high, buy side has been taken when it runs here, that's anchored above this short-term high. The chart on the left here is a 15-minute time frame for a dollar CAD, and the chart on the right is a 5-minute chart. On the economic calendar, you can see at 8:30 in the morning, June 21st, 2022, we had a high impact news driver for core retail sales and medium impact retail sales number. Yellow events, I'm not interested in. Red or medium impact, high or medium impact. Those are the news drivers I'm looking for. So if we look at the price movement on the 5-minute chart, you can see that once we ran up initially at 7 o'clock in the morning. What is 7 o'clock in the morning, New York time? That's the beginning of my ICT New York kill zone. It's extended to 10 o'clock in the morning when it's 4x. So 7 o'clock to 10 in the morning, New York local time. The market creates a short-term high, then runs above that. So we have buy side taken, then the market drops just below here, but I want to have a more meaningful displacement. Okay, we want to see something that's more energetic. This little toe in the water type thing here, that's not enough. We want to see it fall in. Okay, so it drops down, that short-term low here, that's your shift in market structure. Energetic displacement, and that candle is exactly when that news driver came out at 8:30. So all of this is news driver related, economic calendar, manipulation, and the market is going to cause people to want to sell short and chase it going lower. It creates a fair value gap in here on the 5-minute chart, but there also is a fair value gap here. Now ahead of the news, you might be thinking, well, couldn't you have sold short here? Yes, you could have, but the economic drivers that come out at 8:30 could have sent it up higher and taken us into this area here. So really it's a matter of waiting for the news to hit the market and then create the setup. That's a little bit more conservative. There are times when it's so obvious that they're going to continue the move that starts ahead of the new driver. but it takes a little bit more experience to find those setups and trust them. I would rather you use your demo account to see these types of moves real time, wait for them to form, and then go in and engage them with your demo. Not try to forecast how much of a move it's going to further increase higher or lower once the news driver comes out or the news event hits the marketplace. Relative equal lows down here, there's your sell side. So we had this fair value gap formed after buy side was taken here, but now this creates an area of buy side. That once this trades lower, we have this fair value gap and then we have this fair value gap. So it could run up into that level with the volatility. So you're going to have to make sure that you have that defined with your risk management. The draw on liquidity is likely to pull down into here or into this fair value gap. And we'll talk a little bit more about why that's the case. But eventually it trades down into it, bagged and tagged, sell side liquidity. The tweet I posted, again, you can see this at 8:29 a.m., June 21st, 2022. I just made it on Twitter, but basically saying, good morning, folks. Dollar CAD is about to have some volatility. Note the sell side and buy side on your 5 and 15-minute charts. Sell side is here. Buy side would be here. Study if it wants to run sell side before buy side or rebalance to a discount. What does that mean? At the news driver release, it could go up and bump the buy side, then dig in for the imbalance here. That's a discount, or run the sell side out here. So all of this movement up since 5 o'clock in the morning, New York local time, this was just ahead of that news driver here. So they were building in a premium. Then during the New York kill zone, it gave you the setup that I teach in this model, delivered to the fair value gap and delivered to the sell side liquidity pool. Between this high and that low, here's the equilibrium. So we have to find a discount array below that if we're going short. That's the fair value gap here. You can take a partial there and target the sell side liquidity, which you can see it does that as well. Here and here. I tweeted, and I failed to actually include that tweet. I wish I would have put it in here now, but I mentioned how the market reacted here like that, and I stated that's the reason why you want to take partials, because you don't know if it's going to come all the way back up and then revisit this fair value gap and lose the opportunity to bank something when it goes into your first opportunity discount array when going short. Now I've dropped down into a 4-minute chart, and I dimmed the fair value gap that I mentioned earlier, that you could have taken that trade, but it'd be ahead of the news driver, and it's a little bit more riskier. But you wait for the displacement, short-term lows taken, then we have a shift in market structure, and the imbalance would be between this low of this candle and the high of this candle in here. Now by itself, this is a rather elongated imbalance. So all of this sell side delivery is imbalanced, and there's not enough buy side delivery. So it's going to want to wait for the market to come back up in here. In Forex, there is no central measure of volume. Okay, and in the algorithm that delivers price, that is going to want to come back up and overlap this down move and offer buyers an opportunity to get in on that. This is too much of a movement one-sided, so the market offers that rebalancing. So if that's the case, where in this range would we be looking for an entry? Knowing that this fair value gap could be revisited, and you're going to have to utilize that for your stop loss. So your stop would have to be here. Doesn't matter where you're going short in between this low and this high, you have to define the risk with the stop here based on the model I'm teaching you. Now, some of you are like, oh, that's just too much. Because if I went in at 129.45 and I put my stop here, that's almost 12 pips. That's too much. No, it's not. It's all relative. You can scale it. That's one of the benefits of Forex. It's very scalable. Whereas if you're trading futures, you're kind of stuck to whatever the contract size is, and you got to either make it work or you can't take the trade, or you're basically being over leveraged, which is what you don't want to be doing. So if we look at that range from that high down to that low and drop a fib on it, we're going to get a measurement of 50% here. That's our equilibrium price point. So really, we need price to get to that point or higher. So by definition, we could be looking for a short here up to here. And that would look like that. So that's really the range that you'd be wanting to sell short in. So you're not really risking a lot of pips, but you're defining the entry a little bit better. Even though it goes above it a little bit, that's okay. But the bottom line is that it eventually gets in sync. Watch the bodies of the candles support that premium high of the imbalance. Beautiful delivery. Then it starts to break lower. One more time, false little rally. Takes buy side liquidity once more. Then the real move starts to unfold. Trades into the fair value gap here. Take partials. So that way, if this reverses on you, you're paid. And it drops below a low where engineered sell side liquidity would be, and then digs into the sell side liquidity over here. So your entry could be 129.44, 129.47 in that range. Anywhere in there is reasonable. It's acceptable. Obviously, the closer you get to this level, you may not have been filled. It might just leave some of that open and then start to roll over. But as you can see, here it goes a little bit further. That's fine. That's why we have to utilize this level here for our stop loss based on the models rules that I've taught in the 2022 YouTube mentorship. All right, so I have a 4-minute chart here with all the details shown. Sell side liquidity pool, relative equal lows from the morning. It rallies up, creates a high after running buy side liquidity. It breaks down, consolidates, and gives a short-term swing low here with an energetic run lower at the high impact news event at 8:30. Rebalance, stop goes here, and it rolls over during the 10 o'clock to 11 o'clock. That time frame, 10 to 11, that's London close. So if you're looking for directional plays and you're in a trade, you want to have about 80% of your trade off between 10 o'clock and 11 o'clock in the morning, because usually, not all the time, but usually that's when it creates the opposing end of the daily range. So if it's creating the high of the session here, the low is likely to form between 10 o'clock and 11 o'clock. That's algorithmic. Now there's sometimes, if there's news events, sometimes Canadian dollars influenced by crude oil numbers, and that would sometimes skew this time window, 10 to 11. So on those days when there's crude oil inventory numbers coming out and I'm interested in trading the loonie, I will trade with the expectation between 10 o'clock to noon and not have such a tight little window of 10 to 11. And I promise you, I have students for days and days and days and years now that will confirm that this has not just been form fitted for this example. I've always taught that 10 o'clock to 11 o'clock in the morning is London close profit taking hour. I'm quite sure if you go through the older teachings I have in this YouTube channel, you'll probably actually hear me talk about that very thing as well. All right, so we're going to talk about the E-mini S&P futures contract. This is the September contract for 2022. If you're following along on TradingView, and I hope you are, the symbol you would be utilizing for calling up the data for this contract is ESU2022. Okay, and that would give you this chart here. This is a daily chart. And before I get into it, I want to talk a little bit about daily bias. Okay, so this topic is one of the most requested topics that I would cover, and I have done many teachings on it. I've done amplifications, I've done revisits to this idea, and I know what you're wanting, okay, because it's what I wanted as well. You want a simple ABC 1, 2, 3. It always works. It's always going to be the same way. It's always going to be the same procedure, process, and it's always going to give you a winning trade. Now, some of you are already folding your hands and hissing because you're like, oh, that's not what I want. That's not what I want. You're exaggerating, Michael. No, that's really what you want. And you want me to give you a very simple cookie cutter approach to find daily bias. And I want you to understand that I've taught these things many times throughout the lessons and lectures and series that's found on this YouTube channel. This is the simplification that I make for daily bias. If you stick to these rules, you will know how to find daily bias as I teach it. My students follow these rules. Okay. I'm going to go through them with you, and you're going to be kicking and screaming and saying, no, there's something else you're holding back. There isn't. It's experience. It's doing it yourself. But the keys to daily bias are simply this. Everyday bias is unrealistic. If I go in looking for a specific predetermined daily bias before the market starts trading, invariably, I'm going to have it incorrect. Notice I said that I'm not perfect. Some of you hold me up to this hero level status, and I'm not a hero. Okay, I'm just somebody that knows what they're looking for and knows how to avoid, hopefully, making the same mistakes over and over again, because I'm looking for a procedure and process that will lead to an outcome that generally, not all the time, but generally yields a specific result. So I'm not trying to get a daily bias every single day. I'm trying to determine the likely weekly expansion. And again, what is that? I utilize a weekly chart and I study that, and I want to see, does it look like it's going to run to an old low? Does it look like it's going to run to an old high? Or is it running to an imbalance below the market price? Or is it trying to run to an imbalance above the market price? Or is it likely not to move because there's no data for it for that week? And other markets have high impact or medium impact news that would be more interesting, and the algorithm will be working those pairs or markets. And the pairs or markets that don't have a high impact or medium impact driver will probably be a lackluster market environment. I'm looking for the direction of an expansion move. I'm not trying to get the entire weekly range. I'm not trying to buy the weekly low and sell the weekly high. I can, but that's not what I'm trying to do. You don't need to do that, okay? I know some of you hate when I do that, but I'm trying to make sure that you understand there's a distinction between what you should be coming into this with in terms of expectations and what is realistic. Okay, in the beginning, all you're trying to do is determine, is it likely to expand higher? Is there going to be a big move, a flurry of activity going higher during the week or going lower during the week? And by itself, that is huge in terms of what you're trying to pick. Now, you might be wrong, because sometimes I get it wrong. But I'm looking for some volatility in a direction based on what I'm studying on a weekly chart. So this is a daily chart shown on this slide here. The same thing I would be doing to determine where the daily chart's going, I'm trying to do that with a weekly chart. But I'm only interested in seeing what's it likely to reach for. I'm not trying to predict the weekly closing price on that candlestick. I'm trying to look for where is the bulk of that volatility going to be pushing, higher or lower, and why would it be like that? And it's as simple as what I mentioned earlier. Is it aiming for and gravitating towards an old high to run above it? Or is it gravitating towards an old low to run below it? Or is there an imbalance where it needs to come back and revisit that? Because it might just drop down to a fair value gap to go higher longer term. I don't even need to know that. All I need to know is, what direction is it most likely to have the majority of the volume pushing through? Now, when I say volume, there is no centralized volume number in Forex. When I say the volume, that means the interest, the chaos, the energy, all the activity, the action, okay? Is it going to be on the higher side, reaching for buy side, or is it going to be on the lower side, reaching for sell side? That's what I'm looking for. I want to find, where is it likely to gun for this particular week? Who's in the crosshairs? Have people been making money going long? Is there a low that they're going to try to run down and stop them out with it? That would be enough for me to frame an expansion going lower. So I'm looking for obvious liquidity in that direction. Below old lows, above old highs, or identifying imbalances in price delivery top down. That means from the weekly down to the daily, down to the 4 hour, down to the 1 hour, to the 15-minute chart, And then once we get to the 5-minute chart, you do the scalings from 5, 4, 3, 2, and 1, whichever has the clear, obvious fair value gap for you based on the model's rules. And I focus on days that have high or medium impact calendar events only. So if you go through your economic calendar, in fact, you can look at next month's economic calendar. They're already there. Where are the high impact or medium impact news events for the markets that you trade? What day of the week and what time? So if you have a news driver that's coming out on a particular day, say Tuesday or Wednesday, and you're expecting the weekly range to expand lower, well, on those medium impact or high impact news events, I'm going to see hopefully something that is going to run up higher, go into a fair value gap, or run above a short-term high, run stops, then break down, show displacement, then create a fair value gap, and I can go in short on that. And I'm doing that and looking for that setup and that directional price run inside my kill zones intraday. At the same time, the economic calendar is suggesting a high impact or medium impact news event is likely. So what did I just teach you here? I basically said that there is absolutely no expectation on my part to know the bias every single day of every single calendar trading day. I'm only focusing on these sweet spots, these low-hanging fruit days where everything's coming together, all the stars are lining. Okay, I'm looking for the higher time frame weekly to expand in a specific direction. That starts my bias. And then, if I think it's going to be going higher or going lower for a specific target or imbalance, then I'm going to go to the economic calendar to look for when that might occur. Now, there may be a move that happens prior to the economic calendar event occurring, and that's just going to be a missed opportunity. So you have to use something else, some other pair, something else that you got to trade with. Sometimes that occurs. But you'll see that there's a lot of opportunities using this criteria. And it's very forgiving for you as a developing student because it's already given you permission not to know the daily bias outside of these rules. See, you want to trade every single day because you want to be the everyday trader. I don't want to be the everyday trader. The everyday trader is more prone to have losing trades because they are trying to do something every single day when there are times when you should not be trading at all. And that's what makes me different from all the other educators out there because I have made a career out of knowing how not to destroy myself because that's what I did when I was a 20-year-old. I thought that I could trade every single day. And that's problematic when you don't know how to trade and you have a lot of time or lack of self-control. And that's why I was blowing accounts when I was 20 and 21 and 22. That fevered pace of, I got to do it, I'm going to miss that next move. When hopefully you've seen now enough instances where this pattern repeats a lot over the course of a month. It's in most markets a few times a week. But if you notice, those moves are occurring when there's a high impact or medium impact news driver on the economic calendar. So it's something that you can plan for. You ever hear the old cliche remarks of books and educators? They say, plan your trade and trade your plan. Well, this is how you can do that with that model. You look for the economic calendar, the time of day, what kill zone, in the market you're expecting an expansion higher or lower on that weekly chart. There it is. You're looking for these things to repeat. And if you start journaling these things, you're going to notice that the setups, this is one of the epiphanies, okay, because I know some of you just don't want to do this, but now because I'm going to tell you, you're going to go into it hopefully and see that what I'm saying is true. If you backlog every day, show everything that took place, mark up your charts, as I'm going to show you in some examples in here. When that happens, over time, you're going to see that the best setups occur when these calendar events are in play and they originate around that same time. And then what will happen is it'll convince you to say, okay, I don't need to be the everyday trader. I don't need to be in here being super scalper. I don't need to be in here trying to be an Olympic trader, because trading is not an Olympic sport. It's not an Olympic event. And they don't give out gold medals for overtrading. But they do blow accounts. So eventually doing that enough, and if you don't know what you're doing, you're going to blow your account. And that's hopefully what I'm trying to prevent you from enduring. All right, so we're looking at the hourly chart here on the S&P. Obviously, we've traded down. We left relative equal lows, but this low went just a little bit lower than that one. That's all we need. It hit that, and it started retracing higher. This movement here, that's whipsawing both sides of the marketplace. Sell side taken, then buy side taken, and then it broke down. Whenever I see price action like this, I ignore the both side type movement. Usually it's FOMC or some kind of rate announcement type event, and that's what you're seeing here. When I see that, I ignore that wick, and I ignore all these as well. The real range is here. This is manipulation. It's already done. It's not going to hurt you. Focus on this swing here. So when the market drops down, it creates this low, runs a little bit lower. We're consolidating. We had a holiday on Monday. The market starts to drift higher. And what I'm concerning with this run here is this high to that low. And I'm getting my range. Equilibrium is here. So if it's going higher, what's it reaching for? Well, it's going to go into a premium. And then this right here, this imbalance, I'm not really interested in that one because it's overlapping with that equilibrium 50% level of the high to that low. So I want to see it dig into a premium. So even if this is going to go up to go down, I want to know, do I have an opportunity to see it go up into this area here or maybe even up here? So we'll use the first low-hanging fruit approach here. So we have a fair value gap there, imbalance, sell side only. The market's going to want to revisit that area. This is exactly what I teach you. This is exactly what happened. Look at the bodies of the candles. Yes, there's a little bit of movement just above this candle's low, but look at the bulk of these candles, the bodies. They're staying within that range that's defined by what I teach you as a fair value gap in a premium market. What makes it a premium? It's above the 50% level. So it's gone up into that level here and it's consolidating. On the 15-minute time frame, pause the video, look for what you can identify based on your understanding and experience learning under me so far. Okay, if you need more time, pause the video. All right, so here's midnight, New York local time. We had a fair value gap here, bullish order block, these last 3 down closed candles. That's one consecutive order block. It digs into the order block with the fair value gap, hits that during the London session. It rallies up. We create a fair value gap here. It runs buy side here and then creates relative equal highs ahead of the New York session. So the market drops down, goes into the fair value gap here, into the last down closed candle, bullish order block there. That's where you could be a buyer ahead of the 9:30 opening. Why would you feel confident to do that? Because we already have an energetic price run from London Open. The market started at midnight and went where? Did it go up? No. It went down into an imbalance, and then there was a lot of energy off of that. So the market created a short-term shift in market structure here that's bullish. London creates the high or the low most of the time. 70% of the time, you're going to find that that is true if your directional bias is correct. So I'm trusting that that low is probably pricing in the daily low. This retracement into the New York session, we're trading into an order block. We close up this fair value gap. Then we rally a little bit. and drop back down into the fair value gap once more, creating optimal trade entry. That's not what we're going to focus on this one here. But we have the New York AM session beginning here from 8:30 in the morning to 11. This is specific to index futures for the morning session. This is the upper level on that fair value gap on the hourly chart, and this is the lower level on the hourly fair value gap. So that's your targets. It's going to be a draw on liquidity. The market runs from the fair value gap here to the low of the fair value gap on the hourly chart to the high of the fair value gap on the hourly chart after clearing buy side liquidity. On a 5-minute chart, there's a lot of things going on here. You can see we have a low, then we ran that low once more, then it rallies and moves up away from the order block and then back down into the last down closed candle on the 5-minute chart. So there's an hierarchy of how the market's trading down into a higher time frame, to a lower time frame, to a lower time frame, all being supported by down closed candles within the bias that's bullish. And once fair value gaps are being closed in, the market goes higher. So it's signaling to you, it's indicating to you that you don't need an indicator. You don't need some wonky little gimmicky candlestick replacement, okay? The candlestick is telling you everything you need to know. You don't need to have any kind of indicators, no moving averages, none of that garbage, okay? Everything is being shown here in price action relative to time and price. So we have the market starting with a run from this low with a lower low. So what took place here? We'll come back to that in a minute. The market comes back down into a short-term discount relative to the low to the high here. Discount, rallies, and at 9:30 it's consolidating, and then it starts to run. Reaches for the buy side liquidity here, the low of the fair value gap on the hourly chart, and the high of the fair value gap on the hourly chart as it draws on liquidity. 3 targets all hit. We're going to zoom in, and this is a zoomed in chart of the session that starts at 8:30 and going into the 9:30 opening. So we have the low here, lower low into the order block. It rallies, short-term shift in market structure here, comes back down in. There's an imbalance or fair value gap here. These levels are based on the 5-minute chart. So even though we're looking at a smaller time frame than that, that's what we're looking at. But we're going to refine that down into this particular time frame. So inside that, let me go back up one more slide. So inside the fair value gap, we're dropping down in here, but we're doing it into this fair value gap there. Down closed candle, that's an order block, and fair value gap. There it is. You can buy this right there and trust that it's not likely to take that low out. Why? Because we already had a stop running event here. Low, lower low, sell side taken, reaction. Off the order block, we're into the fair value gap. We rallied once more. We created a fair value gap here. Drop down to that last down closed candle. You can be a buyer there. There's buy side liquidity resting up here. That's going to be your initial draw on liquidity. So that'd be a first partial. If you want to add, if you want to pyramid the position, you can add that as it starts to run up higher. But I want to show you the low to the high here. That's 50% or equilibrium. The market drops into a discount prior to that run up here. This consolidation at 9:30, we see it taking off here. It's already done the move of manipulation, knocking people out, retracing, then off to the races. So this is a case where you do not need to wait for 9:30's opening to get that volatility, to get these types of manipulation moves. This is an early setup, discount, fair value gap, and rallies. So notice what's happening. We have an hourly discount that we're trading into here. Then it creates a short-term discount relative to this low, to this high. That's what we're seeing here. Then the market rallies here, comes back down into an order block, and fair value gap, discount, rallies, consolidates ahead of 930. Is it likely to trade back down and take that low out? No, because it's already closed in the only fair value gap that's here. See that? So if you're up here, looking back, it's already rebalanced this. There's no reason for it to go down. It doesn't need to go down here because it's already shown a willingness to want to rally. And this run didn't need to go over here because this low took out that low. So that is all framework and narrative. So all of that comes together. Now also couple that with the 8:30 news event that took place in the dollar CAD. I'm showing you how these two markets relate to one another with the proper context and bias. Dollar CAD, what is the currency's first pair in its name? Dollar. So if we're expecting, as I was hinting at on Twitter, it going down to a discount or running sell side liquidity, that means the bias is bearish. So if the bias is bearish on dollar CAD, that means that it's a risk on scenario. So the markets like S&P, NASDAQ, other foreign currencies are going to be easier to rally versus going down. In dollar pairs, I'm not really interested in anything except for the dollar CAD because dollar CAD had the high impact news event. So I don't need to go to the dollar itself. When I have a high impact news event on dollar CAD, I can go right to that and cut to the chase and determine what the bias is for the morning session. Because if I'm likely to see lower prices on dollar CAD, that's the same thing as saying lower dollar, higher foreign currency. And when the dollar goes down, it's easy for SPUs, or E-mini S&P stock index futures, to go higher. And everything I've shown here is in concert with that idea. So here we have that short-term high, shift in market structure, after the stop hunt, retracement to a discount, the fair value gap, buying here, run to initial target, buy side liquidity, relative equal highs here, it runs that. You can't see it here. Remember, we're dropping down. This is a 3-minute chart now. It rallies up, creates a fair value gap here, overshoots it a little bit, that's fine. Rallies once more, and digs into the high of the hourly fair value gap. And again, kind of like what I was suggesting moments ago, here is that movement up in the E-mini S&P at the 9:30 time period when the dollar CAD was trading down into its discount here. So lower dollar CAD, higher S&P. So as a Forex trader, you could be selling short if you're not an S&P trader, or if you're not trading Forex like me, this is the long on S&P. And you can add in, as it's taking out this short-term high here, you can look for pyramiding opportunities. And what would that look like? Well, I was in a 10-second chart. I know some of you were surprised when I said that. But here is the 9:30 opening here. And we had a little bit of consolidation. Then we had a run higher, creating the fair value gap between here and here. The market dropped down. I'm buying there. It rallies up into that. There's my entry. You can see it right there. That's the fill. That's the price, 37.41 3/4. And as the market goes higher, if you're trading like this, you can take first partials at logical levels, as I mentioned when we were on the higher time frame charts. And as it goes higher, you just scale off what your model, what your approach or your plan would allow for, and then hold something for the rest of the day towards the close, or at least try to see if you get a continuation into the afternoon session. And that would be between 1:30 and 4 o'clock in the afternoon, New York local time. So hopefully this has been insightful to you. Hopefully it has helped you, obviously, in terms of using other markets for intermarket relationships, for bias, how to navigate markets. These are the only two markets I've talked about today. And you can see how they had a synergy between them. There was a movement and kind of like a dance between them, even though they're not correlated. Don't think that there's any kind of correlation between them. It's the fact that it's risk on, risk off. That's all that it is. And I was focusing primarily on dollar CAD because dollar CAD had its high impact news drivers for today. So I was using that in relationship to what I would expect in the S&P market. And I found my trade by utilizing a market I'm not going to trade, but if it's going to give me insights and it's going to go lower, it helps me frame risk on, risk off. Risk on, that means foreign currencies, index futures, stocks go higher, dollar goes down. Risk off is dollar higher and everything else going down. So if you go into your day with those ideas, risk on, risk off, it makes it a lot easier to look for supporting ideas with intermarket relationships, correlations between assets. Like if you are trading like Forex, euro dollar versus cable, euro dollar would be a better trade than, say, pound dollar. If there is an inability for one of them to go low, make a lower low, and one doesn't do that, that's showing you that's the relative strength leader. That would be the better buy in this situation here. Another instance would be Aussie dollar and Kiwi dollar, and New Zealand dollar. If you're looking at situations like this and you find a currency that fails to make a lower low intraday, when it's risk on, you would be buying the risk on higher low currency. And I didn't look at the Australian dollar and the Kiwi this morning, and it may not have presented it, but if I were trading those pairs, and I wouldn't really be trading them because the impact news driver on the economic calendar is again on dollar CAD. So that's the market I would be trading. So a lot of you ask all the time, like, how do you know which pair to trade? How do you know which one to pick? I'm starting that with the economic calendar. But sometimes I may use that market, for instance, instead of it being dollar CAD today, if euro dollar had a high impact news event, I would compare pound dollar and euro dollar for correlation. So I would look for SMT divergence to signal which one I'd rather be in. Just because the news driver is in, for instance, the euro, the better trade may be in pound dollar if they both went down prior to the news event coming out for euro. And if pound dollar failed to make a lower low, I'm buying pound dollar, because they're going to most likely move in sympathy with one another because they're closely correlated. But in the instance of dollar CAD, I'm not going to do anything except for focus on dollar CAD because the economic calendar suggested that's where the volatility would be for Forex today. And you're welcome to go through the pairs and compare and contrast whether that's true or not. I didn't do it, but you can do that on your own. And hopefully you got something out of this one until I talk to you on Thursday for our discussion on money management. That'll complete the 2022 mentorship teachings, and we'll just continuously do market reviews on the YouTube channel Monday through Friday. So I'll obviously be back, Lord willing, tomorrow on Wednesday with a review on something either S&P related or some kind of Forex pair. And hopefully you'll learn something from that as well. Until next time, be safe.